What if I told you that the retirement plan you've been building for the last 20, 30, maybe even 40 years could be cut in half? Not over decades, not over years, but in a matter of months? What if I told you it's already happening to millions of people right now in February 2026, and most of them won't realize it until it's far too late to do anything about it? This is not a hypothetical. This is not a prediction. This is what is unfolding in real time right now in the financial system that holds your entire future. Stay with me for the next 10 minutes, because what I'm about to share could be the most important financial conversation you've ever had. Let's start with the truth that the mainstream financial media is not telling you loudly enough. We just experienced something in the interest rate environment that hasn't happened in modern financial history in quite this way. After years of rate cuts and easy money, the Federal Reserve made a series of unexpected aggressive policy decisions. And then, the market reacted in ways that even the most seasoned economist did not fully anticipate. Bond yields spiked. Credit markets tightened, and the assets that millions of retirees and near retirees were told were safe, treasury bonds, fixed income funds, long duration assets, took a beating that shocked portfolios across the country. You see, there's a fundamental relationship that most people are never taught. When interest rates go up sharply and unexpectedly, bond prices go down. And not just a little. When you have a 20-year treasury bond and rates move by 1%, you can lose 15 to 20% of the value of that bond almost overnight. And if you're sitting in a target date retirement fund, which tens of millions of Americans are, you are holding a massive amount of these bonds right now. So here is the first thing you need to understand. The safe part of your retirement portfolio may have just become the most dangerous part. Now let me paint the picture of who is most at risk, and I want you to think honestly about whether this is you. If you are between the ages of 55 and 70, this is your highest risk window. This is the decade where you simply do not have enough time to wait for long recovery. This is the decade where a 30% portfolio hit can turn a comfortable retirement into a financial nightmare. And this is exactly the demographic that is most heavily exposed to the bond market and fixed income assets that are currently taking the biggest hits. But here's what makes this moment in February 2026 uniquely dangerous. It is not just bonds. The rate shock is spreading through the entire financial system like a slow-moving fire. Mortgage-backed securities are being repriced. Real estate investment trusts, REITs, which many retirees use for income, are getting crushed because their borrowing costs have exploded. Dividend-heavy stocks and utilities, telecom and consumer staples, the so-called defensive stocks, are being sold off because suddenly you can get a comparable yield in a money market account with almost no risk. So investors are rotating out, driving those stock prices down. And right in the middle of all of this sits the average American retiree, watching their account balances on their phone, not fully understanding why everything is falling at once, and wondering what they should do. The answer, the wrong answer that too many people are going to choose, is nothing. Because doing nothing right now is the single most dangerous move you can make. Let me talk about the hidden damage, the part that the account statement doesn't show you clearly. When you're in your accumulation phase, when you're still working and saving, a market downturn is actually an opportunity. You're buying more shares at lower prices. You have time. Volatility is your friend. But when you're in retirement or within 5 years of retirement, the math completely flips. There's a phenomenon that financial planners call sequence of returns risk, and it is absolutely devastating when it hits at the wrong time. Here's how it works. Imagine you retire with $1 million. In your first year of retirement, the market drops 25%. You are now at $750,000. But you also need to withdraw money to live on, say $40,000 a year, so now you're at $710,000. The next year, even if the market fully recovers and goes up 25%, you are not back to $1 million. You are at $887,000. You have permanently lost over $100,000 in purchasing power, not because the market didn't recover, but because of the timing of when you needed to take money out. This is what the interest rate shock of 2026 is setting up for millions of people who are either newly retired or approaching retirement. The damage isn't just in the numbers today. The damage is in the compounding destruction that happens when you combine a down market with ongoing withdrawals. The people who are most devastated will be the ones who had the most conservative portfolios, the ones who were told to shift into bonds as they got older, because those are the assets getting absolutely hammered right now. So what do? Let me give you 5 specific actionable moves that I believe every person within 10 years of retirement should be making right now. Move number 1, audit your bond exposure immediately. Log into your retirement accounts today, look at your target date fund, look at your fixed income allocation, understand exactly how much of your portfolio is in long duration bonds. If you are holding 10-year, 20-year or 30-year bonds or bond funds, you need to understand that these are the most rate-sensitive assets on the planet. You do not need to panic sell, but you need to know what you own and make a conscious, informed decision about whether that allocation still makes sense given where rates are right now. Move number 2, shift towards shorter duration fixed income. If you are going to hold bonds or bond-like instruments, and there are good reasons to do so for income and stability, focus on short duration options. Treasury bills, short-term bond ETFs, money market funds. These still give you yield and safety, but they are dramatically less sensitive to rate movements. You get the income without the price risk. In the current environment, a 3-month T-bill giving you a competitive yield is far superior to a 20-year bond that could drop another 15% if rates move again. Move number 3, build a cash buffer, your retirement runway. One of the most psychologically and financially powerful things you can do right now is ensure that you have 12 to 24 months of living expenses in liquid, safe cash, or cash equivalents. Not invested, not in the market, just sitting there, accessible, protected. Why? Because this buffer means you never have to sell your long-term investments during a downturn to pay your bills. You live off the cash while you wait for the market to recover. This simple strategy can protect you from sequence of returns risk more effectively than almost any other single move. Move number 4, reevaluate your dividend income strategy. I mentioned that dividend stocks and defensive sectors are being sold off right now, but here's the nuance. Not all dividend stocks are equal in a high rate environment. You want to focus on companies with strong free cash flow, low debt to equity ratios, and dividends that are growing, not just high yields. A stock yielding 8% that cuts its dividend and drops 30% in price is a disaster. A stock yielding 3.5% with 10% annual dividend growth and a strong balance sheet is a treasure. In this environment, quality beats yield every single time. Move number 5, stress test your retirement plan right now. Most retirement projections are built on assumptions that may no longer be valid. Average market returns of 7 or 8% per year. Inflation assumptions that were made before the 2020s reshaped our economic reality. Interest rate environments that are completely different from today. I want you to run your retirement plan through a stress test. What happens if the market stays flat for the next 5 years? What happens if inflation runs at 4% instead of 2%? What happens if you live to 95 instead of 85? The answers to these questions will tell you exactly where your vulnerabilities are and give you the roadmap to fix them before a crisis forces your hand. Now, let me tell you what the smart money is doing, because the wealthiest, most sophisticated investors in the world are not panicking. They are repositioning. Family offices and institutional investors right now are moving into Treasury inflation-protected securities, TIPS, which give you inflation-adjusted returns and are less exposed to the kind of pure rate shock we're seeing. They are moving into private credit, which benefits from higher rates rather than being destroyed by them. They are increasing allocations to real assets, commodities, infrastructure, energy, which historically perform well in high-rate, high-inflation environments. And perhaps most importantly, they're getting serious about income streams that don't depend on the market. Annuity structures, rental income, royalties, structured products. Because the biggest lesson that the last few years have taught us is that dependence on a single stream of retirement income, just the portfolio, just Social Security, just a pension, is a vulnerability that can be exploited by exactly the kind of economic shock we are living through right now. Diversification in 2026 doesn't just mean different stocks and bonds. It means different types of income, different types of assets, different types of protection, and different time horizons working together in a single, coordinated plan. Let me bring this home with a final thought, and I want you to hear this clearly. The interest rate environment of 2026 is not something that happened to you. It is something you can respond to. The people who will come out of this period financially intact, who will retire with security and dignity and freedom, are not the ones who had the most money going in. They are the ones who paid attention, took action, and refused to let confusion or inertia make their decisions for them. The worst thing you can do right now is nothing. The second worst thing you can do is panic. The best thing, the only truly powerful thing, is to get informed, get a plan, and get moving. You've spent decades building this. Don't let one season of financial turbulence undo everything. The moves are there, the tools are available, the knowledge is in your hands right now. So take today, not tomorrow, not next week. Take today and do 3 things. First, log into your retirement accounts and look at your allocation. Second, ask yourself honestly whether your current plan was built for an environment like this one. And third, if the answer is no, talk to a fee-only fiduciary financial advisor who is legally obligated to put your interest first, not sell you products. Your retirement is worth protecting, and you, right now, with the information you have, are more capable of protecting it than you think. Don't wait for the next shock. The next one never announces itself.